I love credit spreads. Credit spreads are what I believe one of the best strategies. Low anxiety. You don't have to be 100% right. So today's webinar is going to be on credit spread mastery. Credit spreads, I use credit spreads to generate monthly income, and you can too. Just briefly, I've been a trader for 35 plus years. I own my own hedge fund, Options Infinity Growth Fund, LLC, and I am the founder of what I believe is the best stock education website out there. It is www.optionsinfinity.com. I'm not going to be selling anything today, so take a deep breath and just relax and enjoy my presentation. At the end, I'm going to show you my website, which you can join for free. And I have a lot of information there for either new people in options or people that have been there for a long time to maybe increase their knowledge and so forth. But there's a lot of free information on that website, and it's available to you. Okay, quickly, my agenda today, I'm going to be talking about the time value decay of options. What's the advantage of the strategy to actually sell premium or do credit spreads? What are bull puts, bear calls, and iron condors? How money is made with these credit spreads? 3 ways. It can go in your direction. The market can go sideways, or it can go against you slightly. There's no better trade out there. You can win 3 ways. How do you choose the best credit spreads? Which ones are worthwhile doing? How do I mitigate risks? Then I'm going to be going over some actual trades that I just closed out yesterday. 125% in the RUT, 160% in Google, and 65% in Amazon before the market dropped. I'm going to be going over some long-term trading results and then briefly talking to you about something that Dr. Van Tharp talks about, and that's what is financial freedom? How can you generate income to get financial freedom? Might be a different take on that. And then I'm going to show you my website. Okay. First of all, you've probably all seen this, that first of all, options are, they're made by, the premiums are, you're either intrinsic value, in other words, the real value, if the stock is at 50 and you're buying a 45 call, it has real value of $5, okay? And then there is time value. Time value is the amount that is above the intrinsic value, and that starts at a certain level, and by the time the option expires, it is worthless. Okay, and the time value of options rapidly decays during the last 30 days. Okay, it comes along not necessarily parallel, but this is an exponential drop towards the end, and this is where we want to take advantage of that. I put on all my trades. 40 days is kind of the time when my head starts going ding, ding, ding. What are my trades for next month? That doesn't mean that that's the first day I look at them. I've been looking at them for weeks, but around 40 days is what I've found is a good time to put on the theta trades for the next month. What are the advantages of this strategy? You don't need to know the exact market direction. It's nice to know what the underlying trend is, but you don't have to have it nailed. You can profit with this strategy when the market goes up or down. It yields monthly income on a consistent basis. These are very high probability trades. And I'm going to show you an independent study that was done by one of my mentees and he showed a 75% win rate. Well, it's almost unheard of in the stock market. Almost unheard of that it be that high. It's actually a little bit higher. And if you look at the theta on these trades, mathematically you can calculate that it's going to be a very high percentage trade. And that's what I like. That's what I like. You don't have to constantly watch the market. It's low anxiety, because if you're wrong, it's not going to be catastrophic. You can get good returns with controlled risk. Let's see, I have a question, and oh, by the way, as I'm speaking, type your questions in the box, and I'll try to get over them real time rather than wait until the end and maybe missing some of them. Frank said, in trading weekly credit spreads, not iron condors, do you have more success in the indexes or stock? Actually, Frank, I do not trade in the weeklies. Like I said, I put these trades on about 40 days for the following month expiration. What I found is that sometimes you have to allow the trade to evolve, and with the weeklies, if it goes against you very rapidly, you don't have time to recover. Now, I trade the RUT, Google, and Amazon. Those are the big boys, and I'll talk about those a little bit later. They have excellent credit, and that's what's important here, okay? So one index and two stocks. Good question, Frank. Okay, strategies that take advantage of the theta decay while keeping risk in check are, first of all, bear calls, bull puts. You put them together and you've got an iron condor. Okay, what is a bull put? A bull put is a type of option strategy that's used when the investors expect a rise in the price or staying level or not dropping too much. Basically what you're going to do is you're going to come below the market and you are going to sell one out of the money below the market. Then what you're going to do is you're going to buy one further out of the money. And this is where you protect your risk, okay? If you just did this, you are selling naked, and only the best of the best can get away with selling naked. And a lot of times you make a lot of money selling naked, and you say, boy, this is easy, and then one time you are wiped out. When you buy one further out of the money, it's going to protect you. Now, you're not going to get that $20. You're only going to get the difference between what you sold and what you bought, or the net credit. I never let it go all the way to expiration. I get out either at a certain profit point or a certain loss point. Rex said, it seems like going out longer makes the trade more of a gamble. Wow, that's a that's a term I don't use in my vocabulary, a gamble. This is probably the least. You want to use the term gamble. When you go to a casino, who wins? Do you win? No, the house wins. When you sell credit spreads, guess what? You're the house. You are selling it to somebody who is gambling. There you go. How's that, Rex? Okay, that is a bull put spread. Now, this is a risk profile, and you can see here's the zero line here. You can see that this is the max you can make on this trade, and notice how this is the least that you can lose. It does not fall off like if you were selling naked. Now, the other nice thing about the risk profile is this white line is basically what it's valued that day. And once you know this, you know where your break-even point is. You can set a profit target and you can set a loss target. And when it gets to that point, if I can't make a case to stay in, I am out. I am out. The other thing is I never go all the way to expiration. Usually when I go in 40 days, usually about 2, maximum 3 weeks I'm in these trades, and I've either made my profit or made my losses, and I get out. What software are you showing now, Mike? I use thinkorswim. I'm not associated with thinkorswim, but I have tried a lot of different trading platforms, and in my mind, you can't beat what thinkorswim has to offer. Okay, bear call is just the opposite. The bear call, what you're thinking is that the market is going to decline, and what you do is you sell an out-of-the-money call and then buy one further out of the money. This is just the opposite of a bull put. The operative word here is bear. This is a bearish strategy, whereas a bull put is a bullish strategy. Okay, so what we're doing here is we're selling the 580 call and buying the 590 call. We're not getting that $8 if we sold it naked, but we're getting this protection, and we get a net credit of $220. Okay, this is the risk profile for a bear call. It's just the opposite of a bull put. Came over here and up and over. You see the same thing. Here's your max profit. Here's your max loss. Okay, now you put those two together, this being the bull put, this being the bear call, and this is the risk profile for an iron condor, and that's why it's named. It kind of looks like a bird getting ready to take flight. An iron condor is an advanced option strategy that just puts together a bull put and a bear call. And usually what I do is I look to see if I can place an iron condor first, because with an iron condor I'm going to double my credit. I'm going to get the credit for the bear call, and I'm going to get the credit for the bull put. How far out do you go out of the money, Mike's saying? Usually what I do is go to a theta of 0.1, a theta of 0.1 for the iron condor. If I'm just going to do a straight bear call or a straight bull put, what I'll look at is recent support or recent resistance, and I'll go in and look for which ones are around that area, and that's where I'll set up the strategy. Rex says, I've heard it's better to sell credit spreads at the money. It's more risky, Rex. It's more risky. And you'll see as I go through my presentation, I've been doing this for 35 years. This is how I make my living. Okay? And what I do is I'm not looking for a home run. I'm looking for a consistent equity curve month after month after month after month. So I'm a very conservative trader. I'm a conservative trader. That's why I like to put on bear calls and bull puts that have this risk. I can't lose, but so much money. It's the other reason why I go out of the money rather than at the money, because yes, you can make more money at the money, but it's more conservative if you go out of the money. And that's what Carlos is coming in here and chiming. He's saying the exact same thing I just said. That's very good, Carlos. If you sell with a delta of 1 deviation, you're probably okay. I actually go with a a theta of 0.1, so the trade has a 90% probability. You put an iron condor together, it's an 80% probability mathematically. Does the market know about math? No, no. You're going to get outliers, and that's why I have rules as to when to get out. Do I always do 10 wide spread? Absolutely, and that's one of the risk mitigation rules. Okay, here's the structure of an iron condor, and basically what you're doing is you're taking the credit from a bull put and you're adding it to the credit of a bear call, so you're getting better credit, okay? Now, and Alberto, I will get to your point in just a second, talking about how wide I go with the spread. So hold on, I'll get to that one. Okay, a bull put, you can profit. Let's say you put on the trade right here, and you put on a bull put. So basically, you're going to be coming down here and selling one and buying one. Okay. If it goes up, that's great. If it goes sideways, that's okay. If it goes down a little bit, it's all right. If you stay in there and then get out when it continues to go in the direction, for a bull put, you're looking for it to go up. For a bear call, you're looking for it to go down. But the beauty of these credit spreads are, if you just had a straight option, good possibility you would get out during this drop. You're not allowing the trade to evolve. And this also brings up another point that somebody had asked earlier about doing the weeklies. Let's say you had this on the weekly and you had a bull put and you put it on right here, 1, 2, 3, 4, 5. You'd probably be all right, but here you wouldn't. Whereas if I go 40 days out, you can see it gives me time for it to evolve into where I think it's going to go or go sideways. Okay, now, at this point, that's the enter. That's where I entry. This point, we would have been up 38%. This point, we would have been up 2%. Now, it's very easy to stay in a trade when you're making profit. And look, this thing dropped like a rock, and you're still making money with a bull put till it finally evolves to where you made 84%. And that's a percent of what I would like to see as far as a return on that trade and a return on the credit spread. The return on margin for the credit spread. Here's the bear call. Starts out here, goes down in your direction, pulls back. Say, if you were in a direct trade here, you would say, I got to get out of this. Finally, it comes down here. Okay, so what's this do? You were up 67%. You stayed with the trade, you were down 21%. That is okay. 20–30%, you've got to let your trades evolve. And if you can't afford to lose 20% on a trade, you're putting too much money at risk. You've got to manage, and you've got to do money management. You've got to control your risk. Okay, these are the big boys that I trade. The big boys are the ones that are over $300. And the reason why I do that is you get more credit. You get more credit. If you're going to put this trade on, you're taking a risk. Doesn't it make sense that you get more credit? Abe says at point 2, let me go back to that. Abe, at point 2, would you be assigned that? Let's see, right here, would you be assigned that? Possibly. I've never, yeah, it's happened occasionally, but very seldom. I mean, most people are trading options. Yeah, I know you can, options are really a paper market. Very seldom do you get assigned. And at this point in time, I've still got about 30 days Well, maybe about 25 days till expiration, so probably nobody's going to assign that to you. Anything more recent? Absolutely. I am going to show you this month's recent trades, and I'm going to be showing you this year's recent trades. Amazon, Google, and the RUT are the ones I look at. And here's their stock price, and here's the credit spreads. What I did is I took 43 days left till expiration at a delta of 0.1 for all of these with a 10-point spread. And you can compare that to a stock that it's right around $50. That's why I like the credit spreads for these big boys. Those are the ones that I use. Okay, how do you mitigate risk? You use the big boys, RUT, Amazon, and Google. I use a 10-point spread. I've found out that that's a nice balance between risk and reward. Okay, so in other words, with the RUT, if I sell a 660 put, I'm going to be buying one further out of the money, or a 650 put. Well, that would actually probably be for Amazon or Google right now, because RUT is around 1100. But yeah, the 10-point spread. Now, sure, yeah, you can do 5-point spreads. The other thing is with the RUT doesn't have that many 5-point spreads. It's usually a 10-point spread. Now, if you go with the real cheap stocks, you can get 50-cent spreads. Okay, but if you're going with the big boys, you're going to get a wider spread, and this is the one I've found to be best. I always enter about 40 days out with a delta of 0.1 or at support or resistance, and here is my targets. I either want to make 10% of my margin or lose 6%. Sometimes I stay in a trade longer if it looks like everything is going correctly. Sometimes I'll stay in a trade when I've lost more than that if it's getting to a point of support. As soon as it hits these, I might let it go a couple more days, but I'm probably going to get out. And usually I'm out, like I said, about 2 to 3 weeks before. I want to limit my time in the market, limit your exposure. If I've made 80% of what I want to get, and I've still got 22 days left, I want to get out. Is your margin cumulative per strategy? Yes. The brokers will require that you have a margin for every trade. Okay. What do I use to determine whether it's going to be a bull put or a bear call? I use the regression channel. Regression channel, the regression line is this purple line. It is calculated by taking 50% above the line and 50% of the price below the line. And this is an excellent trend line. And you can take it for any time, I look at about a six months daily chart, and then I have a shorter term chart that I look at. Now, this green line is plus and minus 1 standard deviation. Statistically, what that says is that 66% of prices will be contained within that these lines. The gold line is plus and minus 2 standard deviations. 95% of all prices contained within 2 standard deviations. Like I said earlier, the market doesn't know about math, and you will get outliers. But boy, when you have something that's up around this region, there's a good probability that it's going to be coming down. And if it's down here, it's a good probability it's going to be coming up. 95% of all prices are contained within it. Yeah, you are going to get outliers. This is like the casing of a sausage, and this is the meat. It's going to contain the meat, and every once in a while somebody will poke a fork in there and it'll go out, but that's okay. The regression channel is one of the best tools that I use. I used to plot the regression channels by hand. which took a lot of time. Nowadays on trading platforms, it's done automatically, and you can get regression channels on a 1 minute on a tick by tick chart. It's amazing. It's amazing. Let's see if I understand. Oh, okay. Here's one. Simon says, you wouldn't trail your profit stops. I never use stops, Simon. My stops are mental stops. I know where I want to get out. So they're mental stops. I've had too many times stops being grabbed and off it goes. And I would never trail a mental stop unless I can make a case for why I should do that. Okay. All right. Here's an actual trade that we just closed out yesterday. This is on the RUT. A bull put sold the April 1010. And bought the 1,000 put for $1.70 credit. Now remember, that's $1.70, and for each contract you've got 100 shares, so it's $170 per contract. And when I teach, I usually talk about 10 contracts because it just makes sense to have enough in there so that you don't want to be trading the IWM because that's 1/10 the size, and the commissions are just going to eat it alive on that. Okay. Okay. Why did I do a bull put back here? Okay. I put on the bull put when it was right around this region here. It was just crossing over the regression line. It had just confirmed a double bottom. And I put on a bull put. The Arun indicator was pegged. This is the bullish, this is the bearish. This shows the number of new highs in the last 25 days and the number of new lows. I use this to see whether the market is trending or not. Visually, you can see it here on the regression channel. Notice how it came off the bottom here and bounced up. I felt really good about the bull put. I put that in right over here, and you can, the other thing I follow is a 5, 8, and 13-day exponential moving average line. This is something that I follow. I call this the Fibonacci ribbon because 5, 8, and 13 are Fibonacci numbers. And notice how strong it was. It did come back. It bounced off there. It pulled back. It bounced off there, and I got out right there. I got out with 125%. This is over the last year. 130% on this trade. This was a iron condor. Notice how I could have sold the bear call here and just let the bull put rise, but an iron condor here was 110%. A bear call here was 120. Notice it was up to the +1 on the regression channel. This one was up to the +1. There's a bear call, 55%. 150% in 1, 2, 3, 4, 5 days. Yeah, it's 40 days out, but in 5 days you made it. And here's another iron condor, 105%. Where are my losers? Just like JC was saying earlier, everybody has losers. But this is a very high probability strategy. There will be losers. That's why you have to have good money management rules. How much margin is required for 10 contracts on a 10-point wide spread? Trader says. And that basically is a math calculation. There are 100 options per contract. So 10 contracts is 1,000 shares. 10-point wide times 10-point wide times the 10 is 100, and then if you got 10 contracts, it's going to be $10,000. It's going to be $10,000 per 10 contracts, $1,000 for one contract, and that is the margin requirement. And that's pretty standard throughout the industry. I don't think that's going to vary from broker to broker. Here's an Amazon bull put that I just got out of. We sold the 510, the April 510 put, and bought the April 500. Why did I do that? Because it had bounced off here. It had come up. It was up to the regression line, and I thought that it would continue to keep going up, and you can see that ribbon actually, it came down and actually was poking its head below there, gave it a little bit more time, and then it finally dropped down through here, and I got out right here. And you look at that, and if you had an option in Amazon during this time period, you would have lost money, because for every day, remember, every day theta is decaying. That time value is decaying. With a credit spread, we made 85%. And then we close out the month with a Google bull put that made 160%. Google was what I considered oversold here. Came up, it was bouncing off that line, and then made a little bit of a run. I was good. I was good with going with a bull put. Then it started to just head right off the ribbon, and at this point I had made 160%. It was over my profit goal, but I let it go. I hit the profit goal right here, but I let it go because the ribbon was going so strong. But then 4 days later I was out. Are your ribbons exponential? Yes, they are. I use the 5, 8, and 13-day exponential moving average lines. Yes, Lou, you're correct. $10,000 margin minus the credit that you would get. That's exactly right. It's exactly right. Okay, I give a lot of credence to this chart. This is one of my mentees put this back together. What he did is, after learning about this, he just went in and he said, well, I'm going to back test this, and I'm going to back test this with 40 days out. I'm going to put on an iron condor with a theta of 0.1 for both bear call and bull put. And if I lose 6%, I'm out. And if I make 10%, I'm out. And he just did a mechanical back test and came up with 70% winners over 10 years. This is not me. This is an independent back testing. Independent back testing. Okay? And I give that a lot of credence. Okay. Let me talk a little bit about Dr. Van Tharp. As Reed was saying earlier, I give him a lot of credit for my trading success. He's a psychologist that works with traders and investors. He's written a book, Trade Your Way to Financial Freedom. If you haven't read it, I would suggest it for everybody. His definition, he says, financial freedom is really a new way to think about money. Most people think they win the money game by having more money. Well, how do you know when you've been a success? How do you know when you're doing what you should be doing? It's not give me money, 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 give me more toys, more toys, more toys. What's your goal? Financial freedom means that your money is working for you and you make more money than you need to meet your monthly expenses. Okay? It's a good starting point. It's a good starting point. That doesn't mean you won't spend hundreds or even thousands of hours building the foundation. I've been doing this for 35 years. I might make it sound simpler than it is. It's an easy concept to understand. It's a difficult concept to master. You have to be in the game long enough to see what happens when the market goes against you. How do you handle that? How did your 6% loss rule work out? How's your money management working out? Okay, you need to spend the time to work on this. It'll work. Doesn't mean, however, that financial freedom is possible is possible once you lay the groundwork, and it surely is. Now, there's two concepts. Your financial planner will say, when you retire, you need $1 million in the bank. Well, if that were true, hardly anybody would be retiring. What I think is more important is that you have a strategy to make consistent cash flow. Consistent cash flow. And that's what credit spreads are so good for. Generating monthly income, month after month after month. Yeah, you're going to have losers, but you have your money management to just go right through that. Okay, so you want to learn more? You want to learn more. Like I said when I first started out, I'm not selling anything today. I'm giving. I'm giving. My website is www.optionsinfinity.com. If you want to become a member, it's $49 a month, and basically what it is every night I do a video blog of what trades I see for the next day and how my trades are doing. I not only do credit spreads, I talk about directional calls and puts, and I do weekly options, okay? If you want to do that, that's $49 a month. Right now, if you go in, we're even knocking 50% off that, so it's $25 bucks a month, okay? But what I do want to do is this is my website right here. It's www.optionsinfinity.com. There's me. This is free. When you come in and you sign up for a free membership, I'm going to show you all my strategies. Every night I'm going to talk about what I see the market doing. Now, if you then become a member, you get to see the nightly video blog. And here's the position list. Here's the current position list. These are the trades that I'm only in 1, 2, 3, 4 trades right now. But you know, last month's RUT 110%, 21%, 81%, 21%, 130%, 42, 195. Winner, 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 winner. They're still open trades. Well, how about my losers? Minus 15%, minus 7%. Okay, these are actual trades that I have talked about the night before we made them, and then I talk about them every night on the nightly video blog. Okay. If you want to go further, you can get into live coaching, but I'm not going to even talk to you about that today. You want to get into more on my strategies, here it is for free. And then you want to talk about trading fundamentals, I go all the way back, talk about options 101, the basics. What are the leverage of options, the financially strong stocks, how I pick them, how to set up your charts and thinkorswim, what's the proper trade size for your portfolio, trading psychology. This is all free. This is all free. If you sign up for a free membership, you just come in there and start the series. Start the series. I want my people to be educated. I want them to know what they're doing before they come in and follow what I'm doing. I want them to understand it. Here's a full webinar on the regression channels. Fibonacci and measure moves, I didn't talk about this at all. Macro MACD is something that I have developed. The Arun indicator, I just briefly touched on that today. Okay, so that's what I'm offering today. I'm offering you a free website to come in and start learning. See if you like it. If you like it and you'd like to look over my shoulder and watch me trade real time, you can come in for half priced for the first month and $49 thereafter. It comes to you every night. You just go to the website, you log in, and it's going to be there. I update the blog every night around 5 o'clock Eastern time. Everybody's got my email. They can send me questions. I mean, I've made my money, and now I'm giving back.